Hi everyone, welcome back to Trades, Trends, and Takes. I am your host Kyle. I just wanted to make this video today to highlight the importance of continuing to buy, continuing to invest, and build your portfolio even during down days, down weeks, months, years. And as we're facing an environment where potentially interest rates are going to start being cut and lowered, with that obviously there is now a lot of discussion of, are we approaching a severe recession? Is a recession already here? What do I do in preparation of a recession? Should I be selling my stocks now and then rebuying them at a lower value later? And while that is a good idea on paper, the problem is just that how do you know when it's the bottom? How are you going to time that correctly? And if market goes on to make new all-time highs and you already sold, then when do you buy back in? From an emotional standpoint, you will have a very difficult time convincing yourself to re-enter into the market, especially with a lump sum of money into what are potentially going to be fresh all-time highs. You're going to be telling yourself, I can't be buying here. It's too high now. We're at too high of elevated levels and it must be coming down. And that's simply not always the case. In fact, more often than not, if we look at the stock market historically, that's not the case. The stock market largely over time just continues to drift on upwards indefinitely and bringing up everybody along with it, minus the people who sold off and tried to time the market and tried to buy perfectly the bottoms and sell perfectly the tops. The wise move going forward will just be continue to add to your positions regardless of what interest rates are, regardless of what the unemployment rate is or how the job market is doing, and keep cash on the side or in your investment accounts. Keep 10-15% of your basis as cash and reinvest chunks of that as market dips if and when it dips. Now, we just had a nice 10% dip just last month. And right when indexes hit that negative 10%, I took a little bit of my cash fund on the side and I put it back into index funds, and I'm already profiting on those additions. Now, I didn't go in with all the available extra funds that I had. I just used some of what I had available in case the market keeps on going lower. That way I'm dollar cost averaging if the market does end up keep going lower, and I can end up with an even better position on the way back up. And if I end up with a little bit of money not reinvested as we're breaking into new all-time highs, then so be it. At least 90% of my account is doing the work that it should be doing. I do not think interest rate changes are something to be afraid of though. And interest rate cuts in this situation are not identical to reasons that they happened in the past. There was a lot of focus on trying to prevent recession level events in the past. In today's events, what we're dealing with is a Federal Reserve that is reasonably close to their 2% target. And while personally, I think that it may be in their interest to keep rates where they are at least a little bit longer, I also don't know how much they're going to cut by if they do end up making changes here in the September meeting in a couple weeks from now. So possibly they don't end up cutting by that much and they continue the fight against inflation to get that rate a little bit lower, a little bit quicker towards their 2% target. Or perhaps they do, based on data, feel comfortable that this month and this meeting is the appropriate time to start cutting rates. That may very well end up being the case, but I'm not going to start selling positions and selling index funds on the assumption that if the Fed is cutting rates, then we must be approaching bad economic times. In fact, historically, those do not go in hand. And in my personal belief, that is pretty well based on data. Rate cuts are not inherently bearish, nor are they bullish, just as rate increases are not inherently bullish nor bearish. So every situation is a little bit different. We can look back historically, though, at returns post rate cuts and rate changes over the stock market's well over 100-year history. And we can see that historically, there is still an annual average return of 11% even post rate cuts, even during cycles where there was recessionary concerns. And there was times where the market went on to perform negatively that year instead of positively. But when it does trend positively, in a few years, a few cases, it has gone on to trend extremely positively. In one unique case, looking at historical numbers, the indexes had appreciated by over 80% in 1 year, which is just insane to even think about. So no news on the market today. I'm looking forward to future economic events. I'm looking forward to be able to buy index funds even lower if we do get those opportunities. But in the meantime, I am still very bullish on the market. I think fundamentally not a lot of data has changed to suggest that we're looking at a crash or massive swings to the downside anytime soon. I did pick up a new book recently based on a viewer's recommendation. It is Chip War by Chris Miller. So hopefully once I get a good few chapters into this, then I will be able to share some of what I've learned from this book and give you guys a little bit of info about that too, and maybe it's of interest to some of you if you'd like to pick it up. But it's about semiconductors and Intel and TSMC and some of these manufacturers in that space, and I think it's very relevant in today's times with AI and tech industry and all the boom that we're seeing around that. So just a little something that I'm doing extra in my free time as well. So thank you all for watching. Please consider liking and subscribing, and I will see you all for another video very soon.